On today's show, we're going to discuss what happens when you inherit an IRA. More importantly, what steps can you take to avoid costly mistakes and make the most of this financial legacy? Welcome to another episode of the Simply Retirement Podcast, where we want to educate and empower women to live your retirement on your terms. I'm your host, Eric Blake. Now, whether you have inherited an IRA from a spouse, a parent, or another loved one, the financial and emotional implications can be significant. And unfortunately, many beneficiaries unknowingly make costly mistakes, whether that's triggering avoidable taxes or even missing required distributions. So today, I want to break down and walk you through the top 5 things you should do if you've recently inherited an IRA account or if you expect to inherit an IRA at some point in the future. Joining me once again is Wendy McConnell. Wendy, how are you?
I'm good. How are you?
I am very well. So I'm going to tell you right off the bat, this is your job on this episode, is to keep me out of the weeds. This stuff is very easy for me to nerd out on because I'm one of those weirdos that enjoys this stuff, enjoys talking about taxes and Secure Act and all this kind of fun stuff. But
we hate that in a financial advisor.
I know. So you pay me to do it, so you don't have to, right? That's the way it works.
I will do my best to keep you on track. All right.
So back on episode 50, we talked about this big pending wealth transfer, a significant amount of which is going to be going to women. So it's an estimated, depending on what numbers you're looking at, somewhere between $30 to $34 trillion potentially could be passing to women over the next 5 years, say by 2030. And of that, we know that a significant amount of that will be in the form of retirement assets, and more specifically, IRAs, individual retirement accounts. So obviously, then it's really important to understand the implications of this. So before we get into those 5 things that you should do, I do have a couple of just brief caveats that I want to make sure we get out there first. And that's the first thing, really, the first thing you should do is determine whether you're a spouse or non-spousal beneficiary. But that should be pretty straightforward, right? You either know you're a spouse or you're not.
Yes.
But it is important, right? Because that determines what your options are going to be. And we'll touch on that as we go through it. But that is step 1 is, am I a spouse? Am I not a spouse? The next thing is we have to decide if you've already inherited an IRA in the past, did it happen before January 1st of 2020? So that is when the Secure Act actually went into effect. And you may have heard the term, but the Secure Act changed the IRA beneficiary game all completely. And the reason that's important is prior to that, if you happen to inherit an IRA, whether you were a spouse or maybe you were a daughter, you're just a family member, you had the option of what was called a stretch IRA. You could take distributions over your lifetime. Okay. But that basically went away for non-spousal beneficiaries and a few other categories as well. But thinking about, again, really one of those things we can go deep into the weeds on. So spouses still have potential for taking lifetime distributions. But for the most part, non-spousal beneficiaries no longer have that ability. They now have what's called the 10-year rule. And again, we're going to touch on this, but that's the 2 things I would say right off the bat. And before we get to these 5 critical things to do, are you a spouse? Are you not a spouse? Have you already inherited an IRA? And did that take place before January 2020? And we're going to touch on a few of these little key areas that if you have already inherited an IRA in the past, there's things you want to know, because maybe the Secure Act didn't apply to you when you inherited that IRA. But if something happens to you and then somebody else inherits your inherited IRA, it would apply to them. So it's important to understand how all this fits together. And we're going to go through this as we hit those 5 key things that you should do if you are going to inherit an IRA or have already inherited one. That makes sense, about as clear as mud?
Yes. I mean, I just actually inherited an IRA. So a lot of this makes sense to me. So hopefully we'll be able to, figure out where any problems might lie.
Absolutely. Well, I'd also say just one more thing I'll touch on with the Secure Act is it also created a number of other scenarios that really probably go beyond the scope of a podcast episode. Things like eligible and non-eligible beneficiaries, designated or non-designated beneficiaries. So if you think one of those potentially fits your situation, one of the things I would definitely encourage you to do is talk about it with your financial advisor, talk about it with your tax advisor, because those are, again, really areas that you need to understand your specific scenario to make sure you're making the right decisions.
Okay.
All right, which leads us to step 1. How about that? So work with an experienced financial advisor or a tax professional, preferably both. Preferably you have your tax planner, your tax advisor, and your financial planner working together, because that's really critical when you're making these decisions. Because again, if the financial advisor recommends one thing and all of a sudden it results in a higher tax liability, and that financial advisor lets the tax pro tell you about it, probably not a good thing. That's the word. That's one thing CPAs hate, is being thrown under the bus, because they will then turn around and throw you as a financial advisor. They'll throw you right back under it.
That wasn't my fault. That was his fault.
That's right. You ended up with this big tax bill and he didn't even tell you about it. What is he doing?
Yeah, you don't want
but
that.
it does happen. It does happen. But that is key, is to have both of those professionals working together to make sure you understand what's going on. Because one of the things you want to look at is the expert in this field, or the financial advisor who has experience here, is looking at, making sure you avoid required distribution mistakes and penalties. And making sure also that you think about a tax efficient withdrawal plan. When we talk about required distributions in inherited IRAs, if you've got a required minimum distribution, you could always take out more. And we'll talk about withdrawal strategies here in just a bit, but that's one of the things to be aware of, is there could be tax reasons to actually take more out than what you're required to. And that's where a financial professional who's experienced in these issues can be helpful.
So let me ask a question, and you may be, answering this later on, but if I inherit an IRA, and a traditional IRA, and I withdraw funds from that, I will be required to pay taxes on that money. Is that correct?
If it is a traditional IRA,
okay.
So taxes have never been paid on it, it's still pre-tax. Yes, when you start taking those distributions out, they are going to be taxable to you. And again, that's really where proactive tax planning before an IRA is inherited can also be really important, before it passes on to that next beneficiary. Because you think about, we send out we're actually in the middle of this right now, where we do a tax summary letter. So clients send us their tax return. I go through about a 30-step process of reviewing that tax return and saying, here's some of the key areas that I see, some of the key things that we want to be aware of. And we actually say, one of those things is taxation of IRA assets. What happens if these pass to your children, to your adult children in most cases? So let's think about it. If you're maybe in your 70s or 80s, and now your kids are in their maybe 40s or 50s, they might be in their highest earning years, where you being retired might be in a lower tax bracket.
Right.
So if they were to inherit those assets, and now as you said, they're taking money out, but they're now at that high tax bracket, that means Uncle Sam is getting potentially way more than would have been necessary otherwise without proper planning.
Okay, so the parents in this situation would be more beneficial for them to transfer it or withdraw it or put it somewhere where the taxes will be
withdrawing
paid.
more than, if you're recalling what we call filling tax brackets. So let's say maybe they're in the 12% or the 22% tax bracket, and they've got some room. Maybe they're lower in the 22% tax bracket. Maybe they could convert 10,000, 20,000 is just an example, to say, well, now that money's been converted, we've taken it out of the pre-tax bucket. Yes, we paid some taxes, but now it's in a Roth IRA and will grow tax-free. Okay. Or you might just take it out. There's different ways you can do it. But again, it really is, you want to base it on your specific situation.
Okay.
And that's the other thing I was going to suggest is go back and listen to episode 6. And we talk about working with a financial professional that has experience in IRA distribution issues, retirement withdrawals. Episode 6 is where I talk about the 10 questions you can ask your financial advisor to say, are you experienced? What are you doing to stay on top of tax laws and tax changes? How well do you understand what I'm trying to deal with here if I've inherited an IRA? So that's step 1 is, work with an experienced financial professional or your tax professional, hopefully both working together.
Okay, got it.
All right, so number 2. Next thing is we want to understand, what type of IRA are you inheriting? So in most cases, you're thinking about, okay, we've got a traditional IRA or a Roth IRA, and the implications are going to be different. But you also have situations where, again, back to that spouse, non-spouse question, you say, what type of IRA am I receiving? Am I a spouse? Am I a non-spouse? And then that will give you a indication of what your options are going to be. And just for an example, I think I've shared this story a couple of other past episodes, but this again, it stresses the importance of how critical these decisions are and understanding what your options are. Where we had a client who she was only 58, husband was 62, he passes away. He had just started his Social Security benefits, but because she was 58, she couldn't receive survivor benefits from Social Security. So in her case, because he had a 401k, she could have technically taken money out of the 401k and used that money to live on, but it would have impacted her tax situation pretty significantly. We talked about that on a couple of episodes as well, that mandatory 20% tax withholding if you take money directly out of a 401k. So because she was a spouse, our option for her was to say, well, let's roll that to an inherited IRA, in which case, and because it's an inherited account, she can actually access those dollars before 59 and a half. So again, she was 58 at the time. Had she just rolled that money to her own IRA, which a spouse can do, she would not have had access to those dollars.
Right. Okay.
Again, you have that 59 and a half rule. So in her case, she was actually able to take those dollars out, make sure she had enough money to cover health insurance and some of the other expenses that she was going to be dealing with, again, because she had no real other sources of income. So in her case, that was a critical decision on what options did she need to think about under, again, pretty critical circumstances.
Right.
So then you look at also traditional IRA versus Roth IRAs. So traditional IRAs, they both fall under, if you're a non-spousal beneficiary, for example, they both have that 10-year rule, meaning you've got to fully liquidate that account by the end of the 10th year following the original owner's death.
Okay.
But the difference is with Roth IRAs, because there is no required distributions, they don't have required distributions for Roth IRA accounts. You could really decide should I just let that money grow for that full 10 years and then take it out? Because again, it's tax-free. Back to your question earlier about if I take money out of this IRA, out of a traditional IRA, do I have to pay tax on it? The answer is yes. But with the Roth IRA, it's 100% tax-free.
Okay.
So you want to be aware of that.
It should stay where it is?
It can. So it doesn't mean it has to, but it has to stay. You want to keep it in inherited status.
Okay.
Right? You want to keep it in inherited status. And then again, we're getting into these little weedy type things. So if you're a non-spouse, you have to leave it as inherited status. If you're a spouse, you might consider whether it makes sense to roll it to your own Roth account. And that gets back to whether you're spouse, non-spouse, as to what your options may be.
Okay. So what is the benefit of keeping it as an inherited account, the Roth?
So the benefit, if we're talking about the Roth, the benefit to keeping it as an inherited account is it allows it to keep that money growing tax-free over that 10-year period.
Okay.
Versus saying, okay, I can't roll, if I'm a non-spousal beneficiary, I can't roll an inherited account into my own account.
Okay.
So basically your only option is I just take the money out altogether, take a full distribution, or continue to allow that money to grow over that 10 years tax-free.
So that's the better option. Let it grow.
In most cases, it is. Again, it's very individualized. Okay. You want to make sure you're understanding your exact situation. But when it comes to Roth accounts, tax-free is always good.
Yes, that's the ultimate.
Right, exactly. And again, I'll touch on that one issue I talked about at the beginning around Secure Act versus non-Secure Act. So if you happen to inherit an IRA before January of 2020, that's where, again, you want to understand what rules apply to you. Do you still have that option to stretch out distributions over your lifetime versus being limited to that 10-year distribution time frame?
Okay, got it.
All right, so then we go. Next thing is number 3 is determining whether you will have required distributions. And again, non-spousal beneficiaries, generally, they're going to be subject to that 10-year rule. And technically, that is considered a required distribution. Now, here's where it gets really tricky. So if you inherit the money from the original owner and they were not yet old enough to have their own required distributions, then you don't have to take required distributions out within the 10 years, but you still have to fully liquidate it by the end of the 10th year.
Okay.
And here's where it really becomes costly if you don't understand the rules, because it is a required distribution. If you didn't realize that after 10 years you had to fully distribute the account, you actually could be penalized as much as 25% of the amount that you did not take.
That's if you neglect to do it at all.
If you didn't do it at all, that's potentially 25%. Now they have, again, another piece of the Secure Act is it's 25%, and if you take care of it in a reasonable time frame,
yes,
you can have it reduced from 25 to 10. But 10% is still 10%. If it's a sizable account, a 10% penalty is obviously still pretty significant in many cases.
And if you don't realize until the 10th year and you have to take it all out at once, that's a big tax liability, correct?
Yeah, but that's where the penalty comes in. So technically it's a penalty in addition to the taxes. So not only
Right.
might you have to pay that big tax bill on taking that money out after the 10 years, but then you might have an additional penalty on top of all that.
Right. Okay. So, I mean, just the fact that you would have to take, you would have to pay the taxes on the full amount is bad enough in itself. But then if you're late, then
Right.
there's penalties. Gotcha.
Right. And that's where the planning comes in to say, okay, yes, maybe I don't have to take them out, but usually I just use a simple example of maybe $100,000 that you inherited, a $100,000 IRA. You start thinking about, well, if I don't have to take anything, again, definitely have to take out that full amount by the end of the 10th year. But what is that $100,000 worth by that time? Now, actually, it depends on your investment strategy, which actually we're going to touch on. But let's say that $100,000 is now worth $150,000. Well, if I didn't have to take any money out and I just waited till year 10, well, now I'm taking $150,000 out of whatever tax bracket I'm in.
Right.
So that's where that tax planning really becomes critical. And again, those mistakes of costing yourself significantly. So does it make sense to say, well, I don't have to take it out, but what if I did take $10,000 out per year over that 10 years?
Right.
Take that $100,000
space it out. Yeah.
That's where the planning really comes in. And then again, if you've missed any required distributions, that's where, again, that additional 25% penalty, as high as 25%, 10% if you take care of it within a reasonable amount of time. But again, nobody wants to pay more than they have to. Again, it's the idea, we don't want to give Uncle Sam a tip. We'll pay our share, but not a tip.
No, I think he owes me a tip.
Maybe so. We need to look into that. But so let's see, make sure I covered all my topics here. So so back to the other point. So if the deceased, the person you inherited the money from, if they had started taking required distributions, then you will also have a required minimum distribution each of those 10 years, right? So you will have to take out at least something. Again, always remember the minimum, that term minimum. There's always a minimum distribution, but you can take more if it makes sense. So that's key. Now, here's where you run into this issue of the IRS having to make good on promises that politicians make, right? So since 2019, when the original Secure Act was actually voted into law, we just got final regulations, kind of final guidance in 2024 on how all this stuff was really going to work. Do I really have to take required distributions if the original owner had started their required distributions, or can I delay those? And all these different things. So we really only got the final guidance on this in 2024. And in fact, they actually waived required distributions from inherited accounts through 2024. So 2025 is actually the first year you have to take a required distribution if you're due to take one.
Okay. That's
but
a bonus.
here's the big issue. It does not extend your 10 years.
Oh, okay.
So if you said, hey, well, I don't have, they're not going to make me take it, so I'm just not going to, you still got to fully liquidate by the 10th year following the year of death.
So if I haven't taken any money out in the first 4 years,
yep,
I still have to, for the next 6 years, take all of it out over the next 6 years.
Yeah, or again, you could wait till that final year,
right,
again, depending on the circumstances and what type of account it is. Is it a Roth account? Is it a traditional account? But yeah, so that's where I think people, I've heard this a few different times, is saying, well, did that extend my 10 years? The answer to that is no. So even though Uncle Sam said, hey, you don't have to take this money out, even though you were supposed to for these last 4 years, 2025 is the first year you may have to take a requirement, but you still are under that same 10-year window. So you got to be aware of that.
Okay. It's a lot, Eric. It's a lot.
I know. That's a qualified professional. That's that was step one, right? Now here's one that really does get overlooked, and this is update the investment strategy. So you think about, well, I inherited this account from my father, from my mother, from my grandparents, and you would receive the money and it's still in an inherited account, but the investment strategy never gets updated, right? So you got to think about what your situation is. So whatever their risk tolerance was, whatever their goals were, whatever their investment objectives were, you would hope that they invested based on that. Now, some people are getting more aggressive, some people are more conservative, but you want to be sure that once you've inherited that account, did you adjust the investments based on your specific situation? If you're going to have to take money out, what do you change about your investment strategy based on the need to take money out over the next 10 years? Versus saying, okay, if I can let this money grow, maybe I can be more aggressive. what are my goals? If I say, again, there's always that minimum distribution, but what if I want to use the money for something short term? And say within the next couple of years, I want to take the money out and buy a house. Well, you want to make sure that if maybe they're really aggressive investors and they're still in a bunch of different stocks or maybe aggressive stock funds.
Right.
And we go through a situation like what we've seen this year, and we've seen the market drop, 18%. You don't want the market to drop 18% when you need the money tomorrow.
No.
So you want to make sure you adjust the investment strategy based on your specific situation. And again, I'll refer back to another episode we did back on episode 3, where we talked about 7 essential strategies for successful investing in retirement. And again, whether it's for your own retirement that you've said, yes, I've inherited this money, but I want to make sure it's part of my retirement plan, or if you decided that you need something more short term. And just kind of a rule of thumb for the most part, anything within 5 years that you might need the money for, we don't want to expose that money to stocks because the potential volatility is just too great. That's why we talk a lot about our war chest. So if we have clients that are taking money out to live on, at least 5 years of income is going to be out of the market altogether. And again, that's what helps us get through these difficult periods like we're going through right now, where we see a lot of that volatility or downside potential risk. How do we get through that without having to sell stocks at the wrong time?
Well, and I think it's important to emphasize, because for me personally, it's things that I'm not familiar with, whatever. So I just tend to just put it off and put it off and put it off. And then you might be in a situation exactly what you're talking about is when you realize maybe I should have been doing something before the market took a huge downturn. You could lose a lot of money. I'm just saying, don't put it off. Talk to somebody, figure it out.
That's right. Well, and again, the hard part can obviously be, and you may have experienced this, but the emotional piece of this is, well, I inherited this, and this is the way they did it. I don't want to change that. But then you run into the worry about some of these unnecessary taxes or unnecessary costs of doing that. So even though you've inherited it, there's going to be an emotional component of that. You got to be kind of step back and try to take an objective view, or have an advisor help you take an objective view of how do I make sure this money is most effectively used for me, because that's what the person that made you beneficiary, that's most likely what they wanted. They wanted, if they chose you to be beneficiary because they wanted you to receive this when they were no longer around. So they're not going to want you to, unless it's your choice, to that money to be disappear within a year or two, right?
No.
So making sure you adjust that investment strategy based on what your specific goals are, what your time frame is, and what you want that money to do for you.
All right.
All right. So next we've got number 5 is decide how and when to take distributions. And again, this is really where the smart tax planning is going to be critical. So again, understanding, do I want to take distributions over 10 years? Do I want to take it all as a lump sum for some reason? There are actually reasons why you might say, I might just take it all out in year 1.
What's the reason?
It could be, maybe you went through a job change and or you've taken some time out of the workforce.
You just need the money, what you're saying. Yeah.
Exactly. You might say, hey, I might go ahead and just take the money out because I'm in a lower tax bracket than I'm going to be 3 years from now, 5 years from now, 10 years from now. But that's where the planning comes in. You also want to be aware, and I really look forward to, hopefully in the next few episodes, we're going to talk about the widow's penalty that I brought up on a couple of different episodes. But be aware of what sizable withdrawals might do in situations like that, where you take a big lump sum out, or because you didn't understand the rules, you waited till year 10, and you have to take that big $150,000, $200,000 or more distribution. And all of a sudden now you've pushed yourself into a higher tax bracket, or maybe even you pushed yourself into a higher Medicare premium with IRA surcharges. So again, that's where some of these hidden costs by waiting, or at least not having a plan, can really become critical.
Okay, so who's Irma and why is she charging me?
So Irma is when you reach 65 and you are now going to enroll in Medicare. There's a base premium, which is $185 this year. That's what everybody across the board pays for Medicare Part B. So typically Medicare Part A is free. Medicare Part B, you pay $185 a month, and it gets increased every year based on cost of living. Where there's what's called an IRMA threshold, income related monthly adjustment amount. Let me just get that right. So what happens is if your income goes above a certain level, and there's actually several levels where if you hit one, it increases your Medicare premium. It's called an IRMA surcharge. So if you go above that first threshold, it adds more to your Medicare premiums. You go above that second threshold, it adds more to your Medicare premiums.
Gotcha.
So that's where it can actually cost you quite a bit without knowing, if you're not planning, if you're not, again, not looking out over the next 5 to 10 years, deciding how am I going to utilize this inherited account. So that's things like that can happen where, again, using the spouse example, because that's typically where I see this a lot, is where you maybe had, let's call it $1 million. So the wife has $500,000, the husband has $500,000.
Mm-hmm.
They both are having to take required distributions out.
Mm-hmm.
Well, husband passes away, which statistically is usually what happens. Now all $1 million is in the wife's name, $1 million IRA now. She's still taking required distribution, potentially about the same as what they were taking together, but now she's filing married or filing single rather than married, filing jointly.
Okay.
And also the IRMA thresholds are different. The IRMA thresholds, the tax brackets, all that's kind of about cut in half.
Okay.
So now she's taking the same amount they were taking out when they were together, but now she might be paying at a higher tax bracket. She might be increasing her Medicare premiums, all these different hidden costs that might come into play without really because again, not understanding how all this will actually work out.
Okay. This is why you need the professionals.
That's right. Now, the other one interesting thing that I don't think a lot of people are aware of is something called a qualified charitable distribution. So normally this applies to IRAs, but if you've got any type of charitable inclination, there's organizations that are important to you. One of the things you can do, whether it's an IRA, your own IRA, or it's an inherited IRA, you can actually send money directly from the IRA to the charity, and that reduces the taxable portion of any required distributions that you have.
By that amount or the amount that you would have paid in taxes?
So let's see, I'll use an example. Let's say that your required distribution is $10,000 for the year, and there's a organization that's important to you. There's some groups I'm involved with, that Ladder House Decor or American Heart Association, whatever might be important to you. And you say, well, instead of taking all that $10,000 out and paying tax on it, what I could actually choose to do is say, well, I'm going to send $1,000 directly from my IRA. That's a key. Directly from the IRA to the American Heart Association. So that means my $10,000 required distribution that would have been taxable at the full $10,000. Now I've sent $1,000 to the organization. Now my taxable portion is only $9,000.
Gotcha. I understand.
Right?
Yep.
Now you have to be at least 70.5 to actually utilize this particular strategy. Qualified charitable distributions, you have to be at least 70.5. Again, but whether that's an inherited IRA account or your own IRA, you can use that particular strategy.
Okay. I like that.
And I think it even applies more to inherited accounts, because again, if you inherit an account that's now requiring you to take money out, your own IRA with, again, the Secure Act, now the required distribution age has been bumped to 73 or 75, depending on when you were born. So the 70.5 rule, you might not even utilize that for a while.
Mm-hmm.
But if you inherited an account when you were 65 and now you're 70.5, that might be something you can utilize to help reduce your tax liability.
And the great thing about that too is, again, the charity gets the full amount. There's no taxes deducted for them, correct?
Exactly.
Yeah.
So they get the exact.
They get even more.
For them, it doesn't matter.
Yeah.
But that's where, if you said in reverse of that, let's say, I took my $10,000 out and paid tax on it myself. Maybe I'm in the 12, let's call it the 22% tax bracket.
Right.
But then I send the same money to the charity. Well, it cost you 22%. So
right.
It's more like, $1,000, call it about $1,200 that it cost me. It cost me the $200 in taxes. They still get the $1,000, but now it costs me $1,200 to give them that $1,000.
Yeah.
Versus them just getting the $1,000 and it costing me $1,000.
Mm-hmm. I like it. Well,
right?
I mean, you know what I mean.
Yeah. Now here's one other thing in terms of qualified plans or retirement plan, employer plans. Let's talk about that just for a second. We're talking about some of these distribution strategies. One of the things that we talked about earlier, where you can't convert money from an inherited account to I can't take money from an inherited Roth account and roll it to my own Roth account, or I can't take money from an inherited IRA and roll the money to my own IRA. You can't do that.
Okay.
However, what you potentially can do, if the plan allows, you can actually do a Roth conversion from, let's call it a 401k, because that's typically when we talk about company plans, that's what most people think of. If I've inherited a 401k, I might actually be able to do a Roth conversion of that 401k amount into a Roth IRA. which means you basically have then avoided all the requirements. Again, there is that tax liability. So if you do, so it's $100,000. You said, again, using the example of, hey, maybe I'm in a low tax bracket this year. Why not do a sizable Roth conversion, convert that 100,000 to Roth, and now it's tax-free for the rest of my life. I don't have to worry about the required distributions.
Yeah.
I don't have to worry about the 10-year rule, any of that. So that is one strategy that you want to be aware of, and a lot of people aren't, that if you inherited an employer plan, a 401k or similar, that you may have the option of doing an immediate Roth conversion right off the bat rather than having to worry about all the inherited rules and 10-year rules and all that good stuff.
That'd be nice.
It would. All right. So before, I guess, anything else, Wendy, anything you think I need to go back over before I get to kind of a recap of the strategies?
No, I think I'm pretty straight with everything. And if I'm straight with it, everybody should be straight with it.
That's my entire objective right there, to make sure you got it.
I think I got it.
All right, so let's go through the top steps then before we wrap up. So first thing, again, partner with a qualified tax and professional financial advisor to help you guide you through these steps, help you understand what the rules are. Make sure that they understand what the rules are, though, too. That's a big piece, is making sure they've got experience with inherited accounts, retirement distributions, the tax laws, Secure Act. Make sure they understand all those. Again, I'll refer you back to episode 6. Those 10 questions are a great resource to find out for sure whether they've got that experience. Number 2 is know what type of an IRA you inherited. Is it a Roth? Is it a traditional IRA? Spousal versus non-spousal? That falls into that number 2 as well. Understand if and when RMDs are going to be required distributions. Are they going to be there or are they not? Do you have to deal with them or do you not? Make sure, number 4, make sure you align your investments, align the investments with your goals and your time horizon. That's really critical. Last thing is, again, make tax smart distribution decisions, including things like QCDs, maybe that Roth conversion strategy, if that's something that applies to you. So that is, again, those 5 things. If you understand those 5 things, if you do those, you're going to be in much better position as you move forward with an inherited account. Last thing I also suggest, and this is kind of a bonus to do, if you will go to www.thesimplyRetirementPodcast.com/inherited IRA, we've actually got a free checklist that you can utilize that'll help you answer the questions. What issues should I consider when inheriting a traditional or a Roth IRA? It's a checklist that goes through a lot of these items that we just talked about that you can actually have in front of you as you're trying to navigate these decisions.
All right. Sounds
All right.
good.
Any other thoughts? Anything else you think we need to touch on?
No, I think you've covered it very well, Eric.
Thank you. Again, it's easy for me to get in the weeds, so I try not to, but it's fun. I think it's fun.
Hey, I just needed to know who Irma was, and you told me
Aunt
who
Irma,
she was.
Aunt Irma and Uncle Sam. You don't want to say.
There you go.
Well, thank you so much, Wendy, for joining me once again. To our listeners, if you've recently inherited an IRA or you think you may be inheriting one at some point in the future and you just want to be prepared, feel free to visit us at www.blakewealthmanagement.com. If you are interested in us helping you navigate the retirement journey, just click that work with us, review our Simply Retirement Roadmap process. That is our process for helping you make an educated and informed decision about working with our firm. For all the links and resources to this episode, you can visit www.thesimplyRetirementPodcast.com, including that checklist that'll help you navigate those inherited traditional IRAs or Roth IRAs. And that is it for today's episode of the Simply Retirement Podcast. Until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
That's it for today's episode of the Simply Retirement Podcast. We hope you found our insights and advice helpful in planning for a fulfilling retirement. Don't forget to take action on what you've learned today. Visit our website at blakewealthmanagement.com to learn more about our firm and review our Simply Retirement Roadmap process to get you on the right path to the retirement you deserve. And don't forget to click the follow button to be notified when new episodes become available. Thank you for joining us on this journey, and we look forward to helping you achieve your retirement goals. Remember, retirement is not the end of the road. It is the start of a new journey. So embrace it and make the most of it. Until next time, take care. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor, Blake Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.